Hello everyone and welcome to G2's weekly market update for the week ending 30th January 2026. This week markets digested a steady Federal Reserve policy stance, shifting economic signals across major regions and ongoing geopolitical and political developments. Let us take a closer look at how global markets performed. United States US equity markets ended the week higher, with the S&P 500 briefly crossing the 7,000 mark before racing back. Large cap value stocks outperformed growth while small and mid caps lagged. Communication services and energy led sector gains while healthcare underperformed. On the data front, consumer confidence fell sharply, dropping to its lowest level since 2014, reflecting growing concerns about the economy and labor market. Meanwhile, jobless claims remain relatively stable, suggesting layoffs are still contained. Economic indicators were mixed. Durable goods orders rebounded strongly, pointing to improved business investment, while producer prices rose more than expected, driven mainly by higher service margins. As expected, the Federal Reserve held interest rates steady after three prior cuts, signaling confidence in economic momentum while acknowledging inflation remains elevated. Markets also reacted to the news that Kevin Walsh was nominated as the next Fed chair, adding a political dimension to the policy outlook. Europe. European markets finished modestly higher overall, supported by earnings optimism despite lingering trade and geopolitical concerns. Performance across major indexes was mixed, with gains in Italy and the UK offsetting declines in Germany and France. The Eurozone economy showed signs of steady recovery, with growth accelerating in 2025 and fourth quarter GDP slightly exceeding expectations. Confidence among consumers and businesses improved at the start of the year, helping by easing political uncertainty in parts of the region. However, Germany trimmed its growth forecast for 2026, citing delays in the rollout of key fiscal and economic measures. Elsewhere, central banks remain cautious, with Sweden holding rates steady and UK housing data pointing to softer mortgage demand. Japan. Japanese equities declined over the week as technology stocks came under pressure and a stronger yen weighed on exporters. Investors remain focused on the upcoming general election and the potential fiscal implications of proposed tax measures. Currently, volatility continued, with the yen swinging sharply amid speculation about government intervention. Japanese authorities reiterated their readiness to act against excessive currency movements. In fixed income, government bond yields edged lower following a softer than expected inflation reading, prompting investors to reassess the timing of Bank of Japan's next rate hike. While the Bank of Japan remains on a tightening path, near term expectations have moderated. China. Chinese equity markets were largely flat for the week. Mainland indexes ended little change, while Hong Kong markets posted stronger gains. Looking ahead, economic signals remain cautious. Several major provinces announced lower growth targets for 2026, reflecting concerns around domestic demand and broader growth outlook. These adjustments suggest policymakers are preparing for a more challenging environment amid global uncertainty. G2 takeaway. To sum up, global markets this week reflected a balance between policy stability and economic uncertainty. The Federal Reserve's steady stance reassured investors, but weaker confidence data and political developments continue to shape expectations. While Europe and Japan show signs of recovery, growth remains uneven, and China's cautious outlook highlights the challenges ahead. Markets are likely to remain sensitive to inflation trends, policy signals, and geopolitical developments in the weeks to come. Thank you for watching G2's Global Market Weekly Update. We appreciate your continued support. Do not forget to like, share, and subscribe. We'll see you next week with more insights from global markets. Thank you.